President Trump's tariff policies with a slew of levies going into effect next week. Trump announcing 25% tariffs on cars made outside of the U.S. will be imposed on April 3rd. That's one day after what Trump is calling Liberation Day, April 2nd, when reciprocal tariffs, resumption of the Canada-Mexico tariffs, as well as levies on countries importing Venezuelan oil will all kick in. Our next guest calling the tariff policies a, quote, recipe for recession. We've got Doug Holtz-Eakin, former director of the Congressional Budget Office, here with us now. Doug, you know I love speaking with you. Talk to me about this recession call. How do you see that happening?
Well, I think as was just mentioned by your reporter, there isn't hard data yet that says we're in a recession. So it's not now, but everybody has marked down their forecasts to something that looks like 1% or lower, and we haven't seen the real impact of tariffs yet. We haven't seen the imposition of the reciprocal tariffs and how large they are. I think people are underestimating the damage that comes from 25% tariffs on Canada and Mexico. This is a unified economic entity in North America. Ripping it apart with that tariff policy will do tremendous damage to all three economies. I think that's the one that really hasn't been priced correctly. And, I think it would be just a fundamental policy error for the president to go there.
Doug, the market is still really clinging to any hope of a negotiation and of a rollback of every single tariff that gets announced. Do you think that the market is right in holding on to that hope?
No. I think there are different kinds of tariffs. If you look at autos, pharmaceuticals, lumber, chips, steel, aluminum, those are national security related tariffs in the president's view. The purpose is to get domestic manufacturing and to move the factories onshore. Those are permanent, I think, from the perspective of the Trump administration. Canada and Mexico, maybe there's a negotiation there that makes those go away, but the president has yet to enunciate a goal. Like, what is it that he's trying to accomplish with those tariffs? What would be a successful negotiation? So a little wait and see there. And as I said, they're very damaging. The reciprocal tariffs, country by country, you might go around and get a deal to lower those tariffs, but that's a long process. So I think it would be a mistake to think this is a transitory, blip on the tariff front. They're here, they're damaging, and they're going to have an impact on the U.S. economy.
Yeah, I'm curious, what are your thoughts in terms of how the mechanic works, right? Does it start from the inflationary effects of those tariffs, so consumers will stop buying? Or is it going to be, first, is it going to sort of hit the sort of corporate world that's going to struggle with margin compression, and then they might sort of slow down their spending and their hiring and all that type of stuff? These are the areas where we historically have been the catalysts, if you like, for these recessions. How are you seeing that?
Well, a traditional business cycle in the United States starts with the downturn in business fixed investment. The only exception to that's the pandemic. And so I'd watch the business sector very carefully. I think the uncertainty is already taking a toll. We got a pretty weak capital goods order for February. Ex transportation and defense was down 0.3%. That's a warning sign in my view. I'd keep a close eye on the business community. It's not going to help when households, see the market go down and get cautious. We've seen sentiment decline, and if they get a big price increase on a sensitive category like gasoline, then you've got both the business and the household sector heading in the same direction. That's a recession.
Doug, let's talk about another challenge in the market right now that you're very familiar with, coming from SIBO yourself, and it is the debt limit. We had an update from SIBO calling the X-date to come in August, a little bit sooner than previously anticipated. To what extent do you foresee what the market is sort of hoping for right now happening, which is that we do get these tax cuts, and that is looped into the reconciliation bill, which also allows for an increase in the debt limit, just given that we still have a lot of congressional debt hawks?
I think tying those together is a risky move, personally. There's no penalty for moving the debt limit early. It's simply, you take off the table any sort of showdown over the debt limit. You take off the table any financial volatility that comes with tiptoeing up to the X date. Tying it into the reconciliation process, where you have a really tough tax negotiation that's going to take what I think is most of the year, doesn't seem like a sensible strategy. You're holding your domestic policy agenda hostage to the X date, and you're holding the debt limit hostage to how the tax negotiations go. I'd separate them, take care of the debt limit. That's business that has to happen, and all parties know that, and then move on to really getting the tax bill right.
Doug, I'm curious about your thoughts in terms of raising that debt limit and increasing the size of the debt. Clearly we need to figure out ways to mind our money better. We all understand the long-term benefits of doing that, but there could be some short-term challenges getting there, right? Because we still have to service our existing debt, and interest rates are very high, and the administration has made it very clear that they want to see lower, longer maturity yields, right? For so many reasons, the least of which is it's really holding back certain sectors of our economy. I'm curious on your thoughts on expanding debt and the impact on longer term or long maturity debt yields, right? Is there going to be a push upward, or is it going to be more difficult or challenging for the administration to bring those longer yields down?
Well, I think, first of all, you raise the debt limit because those are past bills already incurred, and that should be separated from taking care of business on the unsustainable fiscal trajectory. And to do that, to really get that under control, you have to do something the administration's been unwilling to do. You have to touch Social Security, Medicare, Medicaid, the big entitlement spending programs. Medicare and Social Security are by themselves more than 1/2 of all non-interest spending over the next 10 years. If you want to control the growth of deficits and debt, you have to come to terms with the spending side of the equation, and they haven't. So I think markets are going to look at that. If they become convinced that no one will take on the mismatch between spending and revenue, they'll be increasingly concerned about the U.S., and we'll see that at longer yields. But remember, there's no quicker way to get interest rates down than to have a recession. So I think in the near term, that's the bigger risk.